Hey, what's up everyone? Welcome back to the channel and I hope you're all doing well. What ETFs pay monthly dividends? What ETFs pay the highest dividend? Can you get $1,000 a month in dividends from ETFs? And are dividend ETFs even worth it? For most of us, it's a dream to be at a point in life where we can actually earn money even in our sleep. Can you actually make this dream a reality? Answer to these questions and more. Let's jump right in. As a Canadian investor, there are very few assets available that come close to consistency and comfort of earning passive income through dividends. And I get it, creating and managing a portfolio of income-generating individual stocks is not for everyone. Fortunately, Canadians have the opportunity to invest in exchange-traded funds or ETFs. They offer exposure to a basket of dividend-paying stocks that let you enjoy the comfort of consistent cash flow that's better than any high-interest savings account. If you want to supplement your income through monthly passive income, there are ETFs in Canada that pay shareholders each and every single month. And if you're looking for a way to earn consistent monthly income through dividends, you'll find this list of some of the best monthly dividend-paying stocks in Canada very useful. So I suggest you bookmark this video so you can refer back to it anytime you want. And if you're new to the channel or you've seen my content before, do me a huge favor, hit that like and subscribe button because it lets me know to produce more content like this and you don't miss out on future ETF picks. And if you don't know what ETFs are, here's a quick summary. ETFs are financial instruments that trade on any stock exchange, just like the Toronto Stock Exchange. These funds invest in and manage a group of stocks, allowing you the ability to enjoy the safety of owning a well-diversified basket of dividend-paying stocks without the actual hassle of picking individual stocks. Dividend ETFs, like the monthly dividend ETFs that I will cover in this video, have a proven track record of paying consistent cash flows. They invest in companies with a proven track record of maintaining dividend payouts that are supported by predictable earnings and stabilized cash flows. And these companies may span several sectors of the economy, which is exactly what you want from a diversification point of view. These ETFs provide risk-averse investors to earn higher passive income than compared to fixed income assets or any high-interest savings account. The first one up is XDV, the iShares Canadian Select Dividend Index ETF, and it's currently trading at just under $30 a share. So why would you want to invest in XDV? Because it gives you exposure to 30 of the highest yielding Canadian companies in the Dow Jones Canada Total Market Index. It employs a rule-based methodology which analyzes stocks by dividend growth, yield, and payout ratio. And third, it allows you to earn regular monthly dividend income. It has an investment objective to provide long-term capital growth by replicating the performance of the Dow Jones Canada Select Dividend Index. And looking at performance, it has an average annual performance since inception of 6.67%. In the last 1 year alone, it has returned over 40%. Not bad from a dividend-paying ETF. Looking at the key facts, it has net assets under management over $1 billion. Trades on the TSX. It has 29 holdings, and it's been around since 2005. It's available for DRIP. It has a monthly dividend payout, which is exactly what you want. The last dividend was 10 cents a share, which gives you a dividend yield of over 4%. In terms of fees, it has an MER ratio of 55 basis points and a risk factor of medium. Looking at the top 10 holdings, these are names you'll definitely recognize, like CIBC, Bank of Montreal, Canadian Tire, RBC, Bell, and the list goes on. And if you look at the exposure breakdown, you'll notice it's definitely heavy in the financial sector at 55%. In terms of communication and utilities, it makes up the top 2 and 3, giving you 80% in just 3 sectors. Personally speaking, I think it's just a little bit overweight in the financial sectors for my own liking. But other than that, there's really not many things wrong with this particular ETF. And going back to performance for a second, if you had invested $10,000 when it initially launched, today you would have just under $30,000 in 2021. And taking a look at distributions, it has paid consistent dividends since 2011. And if you take a look at the last dividends paid throughout 2021, you'll notice that in the beginning of 2021, it was paying roughly 9 cents a share, and now it's paying 9.6 to close to 10 cents a share. So if you're looking for a solid Canadian dividend ETF that pays monthly, XDV is a great option. Next one up is XEI, the iShares S&P TSX Composite High Dividend Index ETF, and it's currently trading just below $25 a share. So why XEI? Because it pays a monthly dividend income, very low cost, and designed for long-term foundational holding. And it seeks long-term capital growth by replicating the performance of the S&P TSX High Dividend Index. In terms of performance, it's very similar to XDV, having produced since inception an average annualized rate of return of 6.67%. The main difference compared to XDV is that it tracks a different index. Looking at some key facts, it has net assets under management over $1 billion, also trades on the TSX. Here is a benchmark for this index. It's different than XDV. The other major difference is that it has 75 holdings rather than the 29 compared to XDV, and it's been around since 2011. Look at the portfolio characteristics. It's available for DRIP and pays out monthly. The last distribution per share was 8 cents per share and has a distribution yield of 3.84%. And looking at the fees, it's definitely on the lower end of the spectrum with only 22 basis points in terms of its MER. Checking out the top 10 holdings, names you should all be familiar with: Canadian Natural Resources, Nutrien, TD Bank, TC Energy, Enbridge, RBC, and the list goes on. But where XDV was heavy in the financial sectors, this seems to be a little bit more well diversified, where the top 4 sectors include financials, energy, communication, and utilities. Looking at the growth, if you had invested $10,000 since the inception of this fund in 2011, you would have roughly $20,000 in 2021. In terms of distributions, it really ramped up its distributions up until 2014. Since then, it has stabilized around the dollar mark per year. Looking at the more recent dividends, you're looking at roughly 7 to 7.6 cents per share every single month. Next one up from BlackRock is XRE, or the iShares S&P TSX Capped REIT Index ETF, and it's trading for less than $20 a share. So why XRE? Because it gives you exposure to Canadian real estate income trusts and gives you exposure to different types of REITs in a single fund, such as retail, residential, office, and industrial. And the best part, you receive monthly distributions. And the investment objective, it provides long-term capital growth by replicating the performance of the S&P TSX Capped REIT Index net of expenses. And looking at performance, it has an average annualized return of just under 10% since inception, definitely beating out XDV and XEI as we just saw. Look at the key facts. It has close to $1.4 billion in assets under management, trades on the TSX, and here's the index. And with this ETF, you get a basket of 20 different REITs. It has been around since 2002, and it's focused on real estate. Look at the portfolio characteristics. It's eligible for DRIP, pays out monthly, and has a distribution yield of just over 3%. Its last distribution was 5 cents per share. And look at the fees. It is on the higher end of the spectrum at 61 basis points, and the risk factor is considered to be medium. And looking at the top 10 holdings, it has some of the more dominant names in the REIT industry in Canada, such as Canadian Apartment REITs, RioCan, Granite REIT, Allied, H&R, Choice, and the list goes on. In terms of exposure breakdown, you get access to retail REITs, residential REITs, industrial REITs, diversified REITs, office REITs, healthcare REITs, and so on. So if you had invested $10,000 in this particular ETF since 2002, that investment would be worth a cool $60,000 as of 2021. Looking at the distribution since 2011, it has paid a consistent dividend since 2011 with a spike in 2013, but generally speaking, it's been around the 85, 79s, and $1.14 in 2018. In terms of the last few months, it has paid a monthly dividend between 3.7 cents a share to roughly 5.2 to 5.1 cents a share. So those are the 3 offerings from BlackRock. Let's turn to a different asset management provider, BMO. Next one up is ZEB, the BMO Equal Weight Banks Index ETF. It has net assets under management over $2.3 billion. It has a market price of just over $37 a share and has an annualized distribution yield of 3.34%. In terms of expense ratio, it's at 28 basis points. The dividends are paid monthly, and it has been around since 2009. The index is known as a Selective Equal Weight Canada Banks Index, and it trades on the TSX. And just like we saw with the other ETFs, it has a risk factor of medium. What are some of the benefits of this particular ETF? It's designed for investors looking for growth solutions. It gives you exposure to Canadian bank stocks, so you get to hold a basket of the largest bank stocks in the country with just one holding. And it's equally weighted to lessen security-specific risk. And as we just saw, each security in this index is allocated an equal weight rather than a market capitalization, which means that one bank on its own can't influence the entire ETF, rather it's influenced by the collectiveness of all the banks in the fund. In terms of performance, if you had invested in this fund since 2009, your ETF would be worth close to $37,000 in 2021 today. So that means on an annualized basis, since inception, it has produced an average annualized return of 11.48%, which is higher than XDV and XEI and comparable to XRE as we just saw. In terms of distribution, it has been paying 10 cents per share every month so far into 2021. In terms of holdings, it has 7 holdings, which should be no surprise as it owns the largest banks Canada has to offer: TD, National Bank, BMO, Bank of Nova Scotia, CIBC, RBC, and the last remaining holding is just cash. Holdings breakdown should be no surprise, pretty much 100% in financials and 100% in Canada. So why should you even own this ETF? Because it gives you exposure to the 6 largest banks in Canada with just one holding. So instead of balancing out RBC, TD, CIBC individually in your portfolio, you just own this one ETF and let BMO do the rest and collect your 10 cents per share on a monthly basis. So for all the ETFs we've looked at, do pay on a monthly basis, but they give you Canadian dividend income. Well, what if you wanted dividends outside of Canada? What if you wanted a basket of dividend paying stocks such as the US? Well, there's an ETF for that, which brings us to ZDY, which is a BMO US dividend ETF. It has net assets of just under $500 million. It trades in Canadian currency. So even though this ETF holds a basket of some of the best US paying stocks, you get to own this particular ETF in Canadian dollars, which avoids any foreign currency. It's currently trading at roughly $34 per share and has a distribution yield of just under 3% at 2.66%. The MER is very reasonable at 33 basis points, pays out monthly, and has been around since 2013. And as I mentioned, one of the best parts is it trades on the TSX. So you can trade a basket of US dividend paying stocks all on the TSX with just one holding. In terms of the benefits, it's designed for investors looking for income and growth solutions. It gives you exposure to higher dividend paying US equities. It has sustainable income with lower volatility than the overall market, and also benefits from local currency appreciation. In terms of risk, it's rated low to medium. In terms of strategy, it has been designed to provide exposure to a yield-weighted portfolio of US dividend-paying stocks. And this ETF uses a rule-based methodology that considers the 3-year dividend growth rate, the yield, and payout ratio to invest in US equities. So if you had invested $10,000 in 2013 into this ETF, your portfolio would be worth just under $30,000 today in 2021. In terms of performance, on an average annualized basis since inception, it has produced 13.41%, easily beating out all the ETFs I've covered so far. It has almost doubled the rate of return from XDV and XEI. 2021 so far, it has paid between 7.5 cents to 8 cents per share. In terms of holdings, it has 104 stocks in this one ETF. So you get a basket of over 100 US dividend paying stocks with this one holding. And honestly speaking, these names here are some of the best dividend paying stocks in the entire world. Microsoft, Apple, Bank of America, Cisco, JP Morgan, Home Depot, P&G, Coca-Cola, Pepsi, Chevron. So why own these stocks individually when you can get a basket of the best US dividend paying stocks with ZDY? In terms of sector allocation, it's very well balanced. 21% from IT, 16% from healthcare, 14% from financials, 12% from consumer staples, and so on. And it's all 100% based in the United States. So just like we saw with ZDY, it is a basket of some of the best US dividend paying companies. But what if you wanted to go beyond the US? What if you wanted a basket of the best dividend paying stocks in the entire world? Well, there is an ETF for that as well, and it also pays on the monthly. Let me introduce ZWG, which is a BMO Global High Dividend Covered Call ETF. So not only do you get exposure to some of the best dividend paying stocks in the world, but you also get exposure to covered calls. It has $103 million of assets under management, trades in Canadian dollars, and it costs less than $30 a share. Check out the yield. It's just shy of 7% at 6.82%. This is one of the highest yielding dividend ETFs I've covered so far. It has an expense ratio of 71 basis points, which makes sense because you get exposure to a global basket of dividend paying stocks and exposure to a covered call strategy. So you can see a premium in the MER ratio. It pays on monthly and it has been around since early 2020. And It trades on the TSX. In terms of risk rating, it has a risk rating of medium. So why would you want to invest in ZWG? Well, it's designed for investors looking for higher income from equity portfolios. It's invested in a diversified portfolio of high dividend global companies. It benefits from local currency appreciation and has call option writing to reduce volatility. Looking at the strategy, it provides exposure to a dividend-focused portfolio while earning call option premiums. The portfolio is yield-weighted and broadly diversified across multiple sectors, and the fund uses a rules-based methodology that considers dividend growth rate, yield, payout ratio, and liquidity. The fund also dynamically writes covered call options. The call options are written out of the money and selected based on analyzing the options available premium. Look at the performance. Even though it's only been around since early 2020, if you had invested $10,000 since launch, today it would be worth over $11,000 in 2021, which is just over a year and a half later. And look at its performance. Since inception, it has produced an average annualized return of 6.7%, which is comparable to the earlier ETFs I covered in this video. In terms of distribution, it has paid 16 cents at the start of the year, but since then it is paying 17 cents per share over the last few months of 2021. No wonder it's such a high yielding ETF. So in terms of holdings, you get exposure to over 100 companies worldwide that are known for paying dividends, such as Microsoft, Home Depot, Verizon, Cisco, Nintendo, IBM, P&G, Intel, McDonald's, and Coca-Cola. It's no surprise most of the names are based out of the US. Looking at the geographic allocation, 65% comes from the US, 7% from the United Kingdom, 6% from Canada, 5.6% from Japan, and so on. In terms of sector allocation, it's also well diversified. 22% from IT, 16% from financials, 12% from healthcare, 11% from consumer discretionary, and so on. So if you're looking for an ETF that pays on a monthly, gives you exposure to some of the best dividend paying companies in the world, and is high yielding, ZWG may be an option. Here's another global dividend to throw into the mix, but this time it's by TD Asset Management. This is known as TGED, and this is a TD Active Global Enhanced Dividend ETF. It's currently trading for less than $20 a share and has an MER of 72 basis points. You'll notice that these ETFs that are based on a basket of global dividend-paying companies are on the higher side of the spectrum when it comes to an MER ratio. The category is global equity, and it's based on the MSCI World Index. It has assets under management just under $200 million. In terms of fund objective, this ETF seeks to earn income and generate moderate capital growth by investing primarily in dividend-paying equity securities of companies located in developed markets around the world. This ETF may also invest in securities of issuers located in emerging market countries. In addition, the ETF may also invest in derivatives to enhance total return. And how do they achieve those objectives? Eligible securities will be selected through an active fundamental methodology that considers an issuer's ability to profitably generate and grow free cash flow and its efficiency in allocating capital. Non-dividend paying companies may also make up to 30% of the overall portfolio. Managers may also use options to enhance income and hedge any or all foreign currency. So what does that all mean? So when we're looking at historical performance, since inception, it has produced an average annual rate of return at 15.54%. This is the highest returning ETF I've covered so far. So if you had invested $10,000 since inception, it would be worth just over $14,000. That's a 45% return in that time frame. In terms of portfolio analysis, 62% is from the US, and international equity makes up 29%, and Canada just 50 basis points. The top 10 holdings include Microsoft, Google, American Express, JP Morgan, ConocoPhillips, Amazon, Morgan Stanley, Nvidia, United Healthcare Group, and so on. And again, in terms of sector, it's also well diversified. Technology, financial services, consumer services, healthcare make up the top 4. In terms of holdings, you get a basket of 72 global dividend-paying companies. It trades on the TSX and Canadian currency. In terms of yield, well, this isn't the right yield. It's not actually 1.14%. It's actually, because it pays a dividend of 6 cents per share on a monthly basis, the yield is actually close to 3.6%. And the last one on my list today is PDC by Invesco, which is the Invesco Canadian Dividend Index ETF. And since inception, it has produced an average annualized return of 8.76%. It's currently trading at $31 per share, has net assets of over $800 million, and an MER ratio of 56 basis points. In terms of holdings, you get 44 companies in this one ETF, and it's been around since 2011. In terms of the index, it's based on the NASDAQ Select Canadian Dividend Index, has a yield of 4.29%. So why invest in PDC? PDC invests in liquid, high-yielding securities of Canadian corporations with a track record of growing dividends. Canadian eligible dividends receive preferential tax treatment relative to interest income, which can result in a higher pre-tax interest yield equivalent. You get growth and income through this one ETF. In terms of top 10 holdings, familiar names all across the board: TD, Enbridge, Bank of Nova Scotia, RBC, BMO, Canadian Natural Resources, Sun Life, and so on. They make up 60.75% of the overall ETF. In terms of sector allocation, it's also heavily weighted in the financial sectors at 52.49%, followed by energy and telecom services at 21% and 11% respectively. Geographic allocation should be no surprise. It's primarily based 98% in Canada. So that is my list of some of the best monthly dividend paying stocks Canada has to offer. Let's summarize what we just saw. Here are the ticker symbols of the ETFs I covered and the names of the ETF. In terms of pricing, ZEB is trading at $37 per share, while TGED is trading for less than $20 per share. In terms of MER, TGED and ZWG, the two global dividend ETFs, have the highest MER ratios, while the lowest cost-effective option is XEI at 22 basis points. The rest sort of fall between that spectrum. In terms of the highest yielding ETF, it's definitely ZWG at 6.82%, and the lowest yielding ETF here is the US dividend ETF from BMO, ZDY, at 2.66%. At the start of the video, I asked, how much would you need to invest if you wanted $1,000 a month from these ETFs? Well, let's take a look. So how do you get $1,000 a month? Well, if you invest over $450,000 into ZDY, that would get you $1,000 a month in dividends. Because ZWG is a higher yielding ETF, you only need to invest just under $176,000 for the same $1,000 a month dividend. Now, what if you only wanted $100? Well, then it's just dividing this amount by 10. So if you want $100 a month in dividends, you need to invest $17,000 into ZWG or $45,000 into ZDY to get $100 a month in dividends. And here's the really cool thing about ETFs. You don't have to just pick one from this group. You can pick them all. You can pick a few. It's up to you really on how you want to build your portfolio, and it all starts by doing your own due diligence. Do these ETFs make sense for you and your goals and your values? So use this list as a starting point if you want to add to your portfolio monthly dividend paying ETFs. Thank you so much for watching. This channel would not exist without your love and your support. If you've enjoyed this video or any one of my other videos, consider hitting that super thanks button on the bottom of this video. It's a new way to directly support your favorite content creators on YouTube. Or if you'd like, you can buy me a virtual coffee as another way to support my content and the channel. All proceeds will be used to bring you even more value-added content that I hope will leave a lasting impact on your investing journey. So if that sounds good to you, check out the link in the description of this video to buy me that virtual coffee. And on that very same page, you can download my custom-built Excel-based dividend portfolio tracking spreadsheet, which I use to track my own dividends, forecast my dividend income, and track my gains, so you can keep track of your portfolio exactly the same way I do. If you have questions for me, feedback on this video, or maybe you have ideas on future content, let me know your thoughts in the comment section. And while you're at it, make sure you've hit that like and subscribe button, or that thanks button. That's it for now. I'll talk to you in the comment section.